Hi everyone, welcome to today's video. Today we are talking about property. It's following on from last Wednesday's video, which talked about how to pick a winning property. Today I thought we'd keep going with the property subject and talk about units versus houses, which makes a better investment. For those of you that have not yet met me, my name is Angela. I started this Money Messenger project as a way of imparting some of my knowledge of financial planning throughout my career of 20 years, what I've learned about money. My background is as a financial paraplanner. I help financial planners to prepare the plans for their clients, which detail recommendations about how to build wealth, repay debt, make the most of their money and manage their cash flow better. So the Money Messenger project is a way that I'm sharing some of that knowledge with the masses. The way this project will work in helping financial literacy around Australia and the world is if you engage with these videos, share them with your friends and family, tag someone you know in this video, someone that you think should watch it. When you're investing in property, and now today's video is mainly about investing, okay? We're talking about investment properties, not so much your home where you live. When you're investing in property, property is bought for several reasons. Shelter, rental income, capital growth. Shelter is when it's your home. That's not what we're talking about today. But investment properties, capital growth, in other words, the property going up over time, or rental income, the rent paid by tenants to the landlord, to the owner. Different properties have different ways that they perform. Some have better income, some have better capital growth, some have a great mix of the two. Units and houses can perform differently. Now, when we talk about units, I'm also mentioning apartments, okay? So when I say units, I mean apartments, units, small villas, complexes, perhaps even townhouses, versus houses, which are just to say a standalone one dwelling on a block, okay? So let's just clarify that from the start. With regards to which one you should invest in and which one does a better job, short answer, both of them. They both have different traits and qualities, and it really depends on some other factors. Your first decision when investing in property is not whether to buy a unit or a house. Instead, you need to focus on three things: the economy, select where you want to invest, which state, which country, where are you going to invest your money. Number two, location, the suburb. That's what our video last week talked a lot about, the suburb that you pick. Location, 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 supply and demand. Where do people need housing? Where do tenants need shelter? And number three, affordability for you as an investor, you as the landlord. It needs to be affordable to buy the property, but it also needs to be affordable to maintain and hold the property. In other words, a good mix of income, rent and growth, low fees, low maintenance, things like that. Once you've picked those, the suburb particularly that you select will generally determine whether you buy a unit or a house. When you go into a particular suburb that you've selected for investments, that will dictate to you what the people in that suburb are after, what is in demand, units, houses. The most important part for a property that you buy is for it to grow over 5 or 10 years. If you buy a property, which whether it be a house or apartment in the beginning, doesn't do anything for 5 or 10 years, then your selection process is a little bit upside down and that needs to be tweaked. So rather than focusing on what type of dwelling you're going to be buying, select the economy, the location, and affordability. Once you've narrowed that down, then you'll see the suburb you picked in what dictates. Is units, are they more in demand, or are houses more in demand? If you have say a trendy inner city suburb with double income, no kid type couples there, professional couples who would like a cafe latte lifestyle, I call it, you know, going out for drinks and dinners, you'll often find that there's more units or apartments in that area versus housing, which is more suitable to families with young children. There'll be more single housing dwellings. Not to say that families don't live in apartments or units, but if you're picking a suburb which is in demand by families, you'll find it'll probably dictate to you that there's more standalone houses in that area. So the suburb, your target market, your tenant in mind will dictate to you a unit or a house. Look at gentrification as well, which is when ugly duckling suburbs that we talked about last week, they're being beautified, they're being gentrified, they're made trendy. Perhaps train stations, railways and things like that are getting developed by the government or other developers as well. When a suburb predominantly has houses in it but is being gentrified, you might find that houses, standalone houses, are being demolished to make way for units, apartments, villas, that type of thing. So if you're investing in one of those suburbs, an ugly duckling suburb I call it, which is being gentrified, you may initially find houses are there for the most part, but they may be getting knocked down to make way for more medium to high level density housing. That will also dictate to you. If you go and buy a house there, wanting to keep it long term, you may find that your house is not so much in demand if the houses are slowly being knocked down and bulldozed to make way for villas and units, for example. There is a saying when it comes to investment property that you've probably heard before, that the land goes up in value. And that's true. The land component of an investment property is what goes up in value, not actually the building. The building itself, the house, the unit, actually goes down in value. It's called depreciation. It goes down a little bit over time each year, and that's from just wear and tear and the age of the property. So often it's said to buy a house will be a better investment because the land component is larger and will go up more over time. That is true in a sense, but times are changing and affordability is also changing. And more often than not, we're seeing a lot more units becoming available or being a lot more affordable as a way of getting your foot into the property market for investing. So whilst it is true that land goes up in value, location is also key, even if it is a unit that you end up buying. Personally, I would rather own 1/10 of a fabulously located unit than 100% of a crappy located house. So yes, land does go up in value, but if you can pick an inner city suburb that is even near close to the city, close to the water, and it's a unit, you may find that definitely outperforms a house. A quick word on new builds versus old builds. And let's talk about apartments to start with. I have done both myself personally. I've developed land, I've bought a block, I've put a house on there, and I've also bought and established properties as well. If you're going to invest in a unit as a way of getting your foot into the market, usually because it's a lower cost than a house, personally, I prefer established. I don't tend to like off the plan large unit complexes for various reasons, but some of the main ones are the price. It should be discounted because you're going to be waiting a year or two or so for your unit to be purchased, to be built, but the developer also has to build that property for you and hold that land over time. And like I said, that could take a year or two. There's costs associated with the developer doing that. So that's usually, I find, factored into the purchase price. Whilst they should be discounted because you have to wait for your property, more often than not, I see that they're not so discounted. They're either at market value or they're even sometimes a little bit higher than market value. So be careful if you're doing off the plan, really check the price. You are meant to be getting a discount because you're putting your faith in the developer to build this property for you over time. Likewise, if you're building a new complex, there could also be some dangers that the project will not complete. The developer could go broke. Something in the economy could change and your property doesn't get finished on time or at all. There are protection measures in place in Australia, but you know, if there's delays and whatnot, or the developer does struggle, then that could also cause you grief. So me personally, if I'm buying a unit, I really prefer established. The property's there, it's ready to go. You can negotiate on the price, the seller is ready to go, and you can get someone in straight away. The caveat to that is that usually they're a little bit older, so maybe maintenance might be more of an issue with an established property. But just keep in mind, if you are investing in units, there's a lot of inner city CBD developments going on in various states of Australia at the moment. There can be an oversupply of those units as well, so I tend to steer clear of some of those. Let's talk also a bit further about unit investing. I've had some questions recently about body corporate fees, strata fees. These are the quarterly amounts, the fees, the contributions that you pay to the body corporate, which looks after complexes when there's more than one residence in a complex, say like a villa complex of 3 or an apartment complex of 8, right up to the high-rise apartments, you know, with 30 or 40 in them. Body corporate fees are not bad. Don't let that deter you from investing in a unit. The body corporate fees are there as a way of all the owners of all the units sharing the cost of the regular maintenance. That might be for insurance for the properties, that might be for gardening, it could be for water rates, things like that. Also, any repairs that need to be done to the actual complex, the corporate areas, the shared areas, the common grounds, that is shared. So whilst you might have a house that needs maintenance done to it, you're responsible for that maintenance when you own a house, you and only you. If something goes wrong and the house, the roof needs replacing, you could be looking at 15 grand or more, for example. But when you have a unit complex, you share those costs. You each pay a quarterly amount to the body corporate. That money is clumped together, which then pays for a lot of the maintenance. If there are any repairs, that's also shared amongst the complex as well. So it can be quite affordable. The caveat to that, I would not pay anything more than say $2,000 to $2,500 a year in body corporate fees. Otherwise, you're pushing over the edge where you could probably be maintaining that same amount for a standalone house. But body corporate fees in themselves are not bad. There is also a thing called a sinking fund, which most complexes of units will have. Some older complexes don't have them because they aren't law, but that is changing soon in Australia, and complexes that have, I think, more than 8 or so will have a mandatory sinking fund. And a sinking fund is a much smaller contribution of money that's put away each quarter, and that's to take care of major maintenance or renovations for complexes. So particularly important with a lot of those, 1970s type unit complexes that do need a little bit of upkeep and a little bit more work, a little bit of renovation. A sinking fund can also be payable. So for example, a unit that I own in Perth, I pay a quarterly amount to the strata, to the body corporate, which covers all the bills and the maintenance of the common areas. And then I also pay a much small amount, like $100 a quarter or something, and that goes to a sinking fund, which is a long-term savings that the body corporate is doing to upgrade and maintain the property, but not necessarily the day-to-day running costs. If investing in apartments, which I have no problem with, units, apartments, townhouses, that thing, a couple of tips. 1, pick a small complex. What does small mean? It's up to you. I like complexes of 3, 4, 5, 8, for example, maybe 10, maybe not more than that. Depends which state or area you're investing in. For example, in Sydney and Melbourne, an apartment complex of 30 or 40 or 50 apartments may not be considered big, whereas in Perth, I consider that very big. The thing with smaller complex is the fees, the running, the maintenance, everything is smaller. It's a smaller scale, but also your supply and your demand is better. So there's less supply of a property in a smaller complex, which means that if a tenant wants to live there, they get to pick from your apartment or one of the other 6 or 7, for example. There aren't 50 other apartments that you're competing for a tenant. I would avoid complexes that have a pool, a lift, or a gym, because the body corporate fees will be higher. That's because when those break down or need replacing, they cost a fortune. So I would avoid them. Tenants may love them, great. Not necessary if you ask me when it comes to investing in units. I'd rather pick a unit that's in a good location, even if it's a smaller unit, but a good location that's in demand. That's what's important. And make sure your body corporate is professionally managed. A resident of a complex might be the body corporate manager, and that's fine as long as they're doing a good job. Even that I call professionally managed. But 9 times out of 10, if you can find one that's actually managed by a strata company, then that's better because it's done professionally, the books are all taken care of, the money coming in and the money going out in expenses is recorded properly, and you don't have any problems. So in that regard, it also takes away a little bit of the risk when it comes to investing in units. When you're sharing the workload essentially with a whole bunch of other owners, you all need to get along. So it's better if that's taken away from one individual's responsibility and put into a management company. That can be better. So units are not bad. Body corporate fees are not bad. However, if you pick a suburb where houses are in demand and you go and buy one of the units that are in the area, even though there's a majority towards houses, you could find that you might buy something that's not in demand. So really check the suburb first. Regardless of unit or houses, check the suburb first. That will determine what you should be buying. So in summary, today we talked about units versus houses. Which one is better? My short answer to you was neither is better than the other. They can be equal, but are used in different times. It depends more so about the economy, the location, and the affordability of your property. Once you have those selected and you're ready to buy something, then and only then do you start looking at the type of property that you will be buying. You can do the figures on both when you're investigating a suburb, houses versus apartments, what's the rent difference going to come in, the expenses, but the area you pick in will dictate what's in demand by your target market, your prospective tenant. So just remember, supply and demand. If you get that mastered, then you won't have a problem with property regardless if you buy a house or a unit. Thanks for watching everyone today. Please tag a friend who should watch this video. The way that we will improve the financial literacy around Australia and the world is if you tag a friend who should watch this video. And please subscribe to the Money Messenger website, www.moneymessenger.com.au. And I will see you all next week on Wednesday for our next video. I have a feeling I'm going to keep this property investment train going for a little bit longer. Next week, I'm thinking we're going to talk about how to buy property even if you have a low income. So stay tuned for that one.